Before we can learn to record transactions in a journal, we need to first learn about 3 new types of accounts and something called the chart of accounts. But let's first start off with a new account called Notes Receivable. Notice it has the word receivable in it, and any account that has the word receivable in it means we're going to receive something of value in the future. And because it has a future value, that means notes receivable are assets. Now, a business may sell goods or services and receive a written promise by a customer to pay a fixed amount of money by a certain date. Now, for the seller, this would be a note receivable because the seller is going to receive cash from the customer sometime in the future. Now, on the next slide, we'll find out that for the buyer, this would be a note payable. But let's stick with the note receivable side of things. So your first question should be, well, how are notes receivable different from accounts receivable? Well, notes receivable are always written. Accounts receivable is not written. So when it says it's written, it just means it's a contract. So notes receivable usually include interest payments. Accounts receivable does not. So because you're going to charge someone interest, you need to have them sign the contract. That's why it says in the first bullet point that it's always written. So the buyer is going to sign a contract saying, I promise to pay you such and such amount in the future plus interest. And why are you charging interest and accounts receivable does not? Well, accounts receivable means you're just giving the customer 30 days usually to pay off the account receivable. With notes receivable, the time span is usually much longer, like 6 months, 12 months, 18 months, 2 years. Because it's a longer time period, you're going to charge them interest. So now we'll learn more in depth on notes receivable in a future chapter. So now let's talk about another type of account called notes payable. Because it has the word payable in it, that means we're going to have to pay something in the future, therefore it's a liability. So now again, a business may sell goods, just like the previous slide says. A business may sell goods or services and receive a written promise by a customer to pay a fixed amount of money by a certain date. Now for the buyer, and the key word is the buyer, for the buyer, this is a note payable because the buyer is signing this contract saying, I promise to pay you this amount in the future plus interest. So how are notes payable different from accounts payable? Well, notes payable, just like notes receivable, are always written. Accounts payable is not written. There's no contract. Notes payable usually includes interest payments. Accounts payable does not. So why do notes payable usually include interest payments and AP does not? Well, remember, accounts payable is usually due within 30 days. With notes payable, you're not going to expect payment for a lot longer time period, like maybe 6 months, 12 months, 18 months, or 2 years, something like that. So because it's a lot longer time period, there's going to be interest that needs to be paid. And our last new account that we're going to learn about in this video is called unearned revenue. This happens when cash is collected before the revenue is earned. When it says before the revenue is earned, that means the company collects cash, but they've not yet performed the service for the customer, or they've not yet given the product that the customer ordered. So the most common example of this is the magazine subscription. So the way a magazine subscription works is the customer sends payment to the magazine company, and the magazine company receives the cash, but they don't send out the 12 issues yet. It's going to take them 12 months to send out those 12 issues of that magazine. So the day that the magazine subscription company receives the money, they now owe the customer something, either 12 issues or they got to give the customer their money back. So that's why this unearned revenue is a liability, because the company owes the customer something. So the main thing to remember about this slide is if a company receives payment from a customer but does not provide the service or the product right away, this will result in a liability, as the company owes the product or the service, or they have to give the customer their money back. So receiving cash from a customer and not giving the product or the service right away means we would have to record an unearned revenue. And if it was a subscription we were selling, we would probably call it unearned subscription revenue. And we'll do some examples of this in the homework, and it'll make a lot more sense once you see the actual transactions. So the last new thing we want to cover in this video is called the chart of accounts. What is a chart of accounts? It's a numbering system of accounts that lists the account titles and account numbers to be used by a company. It does not contain account balances. And notice it also lists the account category: assets, liabilities, equity, revenues, and expenses. So the accounts are listed by account type. The order is assets, liabilities, owner's equity, revenue, and expenses. So the first category is assets. All the asset accounts begin with a 1. Notice they range from 101 to 191. Cash is usually account 100 or 101. Now assets are listed in order of liquidity. That's not super important to know this chapter, but we will need to know that in later chapters, so we might as well talk about it now. So when we say that assets are listed in order of liquidity, that just means the assets that are to be turned into cash the soonest are listed first. So cash is listed first because it's already cash. Accounts receivable is usually the second on the asset list because the company hopes customers will pay soon, usually within 30 days. Equipment, buildings, and land are usually listed last because these are not expected to be turned into cash anytime soon. After assets, we've got liabilities. Liability account numbers start with 200. Liabilities are listed in order by when they will need to be paid, with the liabilities due the soonest being listed first. Since accounts payable are usually due within 30 days, they're usually the first liability in the list. Now, in this class, we don't use the account number very much, but when you start to use accounting software, you'll notice that every account has an account number listed with it. A couple of reasons for that. One, if you know the account number, it's much faster to type the account number than to type the account name. And also, you could tell the account type by the number that it begins with. Next, we have owner's equity accounts. And notice that includes capital and drawing. Those two are usually paired together. And notice that they start with the number 3. Capital is usually going to be 300 or 301. Next, we have the revenue accounts. Revenue accounts are in the 400s. The service revenue account is usually 400 or 401. This company has 2 revenue accounts. To keep things simple, our homework problems usually only show the company having 1 revenue account, but that's kind of unrealistic. So realize that most companies have multiple revenue accounts. For example, a lawn care business might have a mowing revenue account and a landscaping revenue account. That way they can see which service is the best seller. How many revenue accounts do you think Amazon has? Thousands. And notice this company has 2 revenue accounts: service revenue and then interest revenue. So interest revenue would be like if you have a savings account or a checking account that earns interest, any interest that you earn is considered interest revenue. And finally, expenses fall into the 500s. And the expenses can be listed in any order. So the chart of accounts is not a financial statement. It's simply a list of the accounts that a company has. For example, let's say you work for this company and they get an electricity bill. You pay the electricity bill and then you need to record the transaction. Remember, each transaction must affect 2 accounts. So which 2 accounts are affected when you pay the electricity bill? Well, cash goes down. That's the easy one. So that's one account. What's the other account? Well, it would be an expense account. So what expense account would you use? Looking at the company's expense accounts, notice they don't have an expense account called electricity expense. So which expense account would you use? You would use the utilities expense account. Utilities expense includes things like electricity, water, and telephone. So remember, you can only use the accounts listed on a company's chart of accounts. You can't just make up account names on your own. Otherwise, one accountant might call it electricity expense, and another accountant might call it power expense, etc. Using multiple names for the same expense account would make it difficult to run a report that would show your total electricity expense over time.